Hi, this is Tom, and in this video, I'll help you save yourself from yourself. In other words, I'm going to prevent you from doing stupid shit. All I need is just your attention. Don't click nothing, don't smash nothing, don't subscribe to nothing, don't buy nothing. Just listen. Now, this is a very common mistake people do every day, and it's also a very costly mistake. It costs people a lot of money every single day, and in about 5 minutes, you're going to be stupid shit proof because you're going to see how to avoid it. As simple as that. Now, what I'm talking about is adjusting your portfolio. And of course, you don't need me, Uncle Tom, to explain to you about the importance of adjusting your portfolio. That's not the purpose of this video. What I want to show you is a very common mistake people do when they actually adjust, and also a quick little tip on how to decide which stocks to move and which to keep. Now, for those of you who are new to this channel, just a quick explanation. Adjusting your portfolio just means one simple thing. Taking out stocks that you think are not going to do well in the next 6 months and bringing in stocks that you didn't have earlier that you think are going to outperform the market in the next 6 months. It's basically like being a general manager in the NFL or in the NBA, right? You want to decide which players to keep for this season, which players to release, and which to trade potentially. So it's the same thing. This is your roster and you try to optimize it for the next season. So let me give you an example from sports, right? If you are talking about a team who's running for a championship, they want more veteran guys, more skilled guys, pay them more. But if you are rebuilding a team, you want younger guys, less salaries, guys that are going to optimize in 4 to 5 years, not right now. So it's the same thing with adjusting your portfolio. Think of it like a sports franchise and you're the general manager. Now, in your general manager position, basically, you have a lot of responsibilities. One of them is managing risk. So when you look at your portfolio, let's say that you have a portfolio that's full of growth stocks, right? Technology, growth, a lot of upside in the future, right? Good. I also have the same thing. However, we do know that a storm is coming. It's inevitable. It's going to come. Tapering is going to happen. Interest rates will go up. Tech stocks will go down. There's going to be a bloodbath. And by the way, I am holding a lot of cash on the sidelines just waiting for this to happen. And I think most reasonable people do the same thing, but this is not the point of this video. So basically what will happen when tapering begins, when interest rates go up, is the discount rate, which is the staple of our DCF system, discounted cash flow valuations, is going to go up. Because it will go up. It will go up from 10%, let's say in my portfolios, to let's say 12%. Or even, let's say, from 12% in certain other portfolios to 14%. But whatever happens, the increase in interest rates will drive the discount rate up in those DCFs. Now, if you don't know what the DCF is, if you don't know what a discount rate is, don't worry, I'm about to explain it in one sentence. The only thing it means is how much future upside of companies is worth today. And it's opposite. The higher the discount rate is, the lower the value today of the future upside. So when DCF discount rates go up, future upside of companies go down in value. Very, very simple. And of course, this is what we're about to experience. When tapering begins, when interest rates go up, future upside is going to be worth less today, which means a lot of tech companies, like a PLTR, for example, will have less of a valuation today. And you should prepare because you know you're going to be able to buy these companies cheaper once that happens. And if you're holding on to these sort of companies, you know that maybe you should unload them now, get them later when it's cheaper. Now, there's an old movie, I forget the name, with Mel Gibson, and he was playing like an army captain, and they were going to Vietnam, and he was asking the sergeant, like, hey, why don't you have a gun? We need to issue you a gun. And the sergeant said, well, by the time I need a gun, there's going to be plenty of them lying around, which is pretty much a very similar analogy to what we're talking about here. So you do need to readjust your portfolio in the sense like you got to prepare for the interest rates going up. I've did many videos about this. I told you which industries you might borrow companies from, which industries are going to do well, which companies. I've did all that. This is not the point of this video. In this video, I'll show you how to do the actual process because the process can actually cost you a lot of money. So let me give you an example. Let's say that right now we have 5 stocks in our portfolio, right? Let's do 5 stocks. This is 2021. This is 2022, right? So this is current, this is future. And right now we have a Tesla, we have a PLTR, right? We have NVIDIA. Sorry for my bad English. And this is a 3. And let's say we have 2 speculative. Let's call it spec with an E. A and spec B. Speculative A, speculative B. Speculative only means that the stock is basically not currently profitable, not currently performing up to its potential, that the majority of this stock is actually in the future, like a startup or a biotech or a company like CheckCap, for example, or a company like ORTX. A lot of these companies in the healthcare industry, but also in the fintech, in every industry, you have these speculative plays. For example, Senseonics versus Dexcom in the GCM continuous glucose monitoring system, but basically in the diabetes industry. There's a lot of these. So we have two of these speculative ones and basically three massive companies that are currently cash flow positive. So even though these companies might be qualified as cash flow positive, Palantir would definitely be the weakness point in this because they have a lot of their upside in the future. So we have here three companies which we identified as companies that we might want to consider taking out right now. Now, obviously, as you know from my own previous videos, I'm not touching Palantir, but this is my own personal preference. Now, you don't have to follow my suit. I'm never selling Palantir. Well, not never, not in the next 10 to 15 years. So I'm not going to be readjusting using Palantir. But again, in this example, I'm going to be using it as one of those players that you might want to trade as a portfolio manager. And now it's a tough decision time because we have to make a decision which stocks to keep, which stocks to drop. So in this case, definitely Nvidia stays, definitely Tesla stays, obviously already cash flow positive. I don't think Tesla is a speculative play anymore. And I think that's it. I think if I have to be objective about Palantir, I think there would be good opportunities to get Palantir for cheaper in about 3 to 4 months. Not sure about 6 months to a year, but after tapering, I think Palantir is going to take a little slump, so you might get it for cheaper. Again, not going to do it myself, but you're more than welcome to try it. Again, just my opinion. I'm not a financial advisor. Let me just put it clearly. Not a financial advisor, right? Sorry for my English. I don't know why it's not writing. Basically, not a financial advisor. I'm just sharing my opinion. Might be inaccurate, might be wrong, might be the ramblings of a madman. You know how the drill goes. So let's say that we want to keep Nvidia and Tesla in this example, right? So now comes the interesting part. So you're thinking about selling Palantir and selling these two Spec A, Spec B, speculative plays. And now we come to the meat of it. If you lasted this long in the video, now you're going to see the mistake most people do. Now they'll analyze which companies to keep, which companies to basically dump, and they will forget one important thing. Check this out. I'm going to start a new page just to show you what I mean. So now they will forget one simple thing, which is when you bought the stock. Let's say I bought Palantir on January 1st, 2021, right? January 1st, 2021, I acquired Palantir shares in the amount of, let's say, $1 million. Right? Okay. And now, let me show you a little trick. Now, I'm thinking about selling Palantir. What happens if I sell these 1 million shares today? Let's say D for dispose. What happens is, I have a profit, right? I bought it for, let's say, $10 million because the price was on the IPO, I think it was $10. So let's say my basis was $10 million. This was my basis. I'm selling it right now for 2.5 times $25 million, which is the current market value, roughly. Of course, we're not doing exact numbers. So right now, I have taxable income of $15 million. That's my taxable income, $15 million. So far, so good. Bear with me. This is about to get interesting. So right now, here's the interesting part. So we have these $15 million, and now I want to show you what happens next. So I want to pay taxes on these 15 million as low as possible within the bounds of legal parameters, right? We don't want to do anything illegal. We don't want to evade taxes. So we have a $15 million tax liability potentially. And now, let's say I'm showing you the date again. So how much time has gone by since I acquired the stock until now? 10 months. 10 months. So under a year. If I held this Palantir shares under a year, sorry about that. My bad English is acting up again. So if I held Palantir for under a year, what happens is my tax bill is going to be very, very high. It's going to be short-term capital gains. STCG. Short-term capital gains, which means it's anywhere from, let's say, 25 up to 37%. Regular income, 37%. That's the top federal rate I think you can pay. And at these levels, it's going to be 37%. Of course, this is a progressive system, not 37 on everything, but for the most part, you'll pay 37%. Now, some of you may say, well, Tom, the capital gains tax according to the federal IRC Internal Revenue Code is 15%, right? So how come we're paying 37%? It's because you held it under a year, dummy. If you hold a certain stock under a year, you pay good income tax, not bad capital gains tax, which makes the government and the IRS very happy to charge those taxes. Now, here's the thing. If you held this thing for 2 more months, you have a 1-year holding period, and then your tax rate goes down from 37% to you know how much? 15%. 15% if you just wait 2 more months. You see the difference? It's a 27% difference on your tax bill. These are huge dollars. It's a lot of money. So you don't want to do that. So the question you have to ask yourself when you analyze which stocks to keep and which stocks to release from your stable or your roster, whatever you call it, you have to ask yourself the question, well, I like PLTR, I like Spec A, I like Spec B, so let's decide which ones I want to sell. But before I pull the trigger, I want to make sure that these are not short-term capital gains. Because whether you have a good candidate for disposability or not, you got to ask yourself the question, when did I buy this stock? Did I hold it more than a year or not? Because if you held it under a year, your tax bill is going to be 25% higher, and that might eat away at your profit, at your delta of whatever you're about to make from this adjustment. So that adjustment becomes much less attractive, or rather, I should say, less attractive if you pull the trigger under a year. So the first thing you check before you start to analyze which companies you want to get rid of is the purchase date. Purchase, can't write in English. I do it in Russian next time. Purchase date. That's the key metric. You do that before you check which ones you want to get rid of. Because otherwise, and people find out that post factum. They found out usually when they pay taxes that they got screwed because they were so smart, but they forgot about the taxes. Don't be that guy. Now, just a little bonus, if you lasted this long in the video, I do appreciate it. And by the way, we just hit 250,000 subscribers on our channel, which is incredible. Thank you all. And if you stayed this long, I'm assuming you're a subscriber, so thank you. One little tip, when you do this kind of readjustment, just make sure you do something very simple. What you want to do is basically prepare this list in your head. And in this list, you got to make sure to basically say to yourself, okay, I have 5 companies, A, B, C, D, and E. Right? The same thing as a general manager does in the beginning of a season. And you got to say ranking system from 1 to 5. Which is my favorite, which is my second favorite, my third favorite, my fourth favorite, my least favorite. And then you say, okay, I want to keep these. These I don't want to touch. These are my LeBron James, right? I can trade these. These are my Kyle Kuzmas. This is my Caldwell Popes. These are the players I can trade. But these ones I'm keeping. And this one, for the right price, I might keep it. But basically, you do this analysis, you do the ranking system on a piece of pen and paper, and you write it down, or a computer, whatever, and you see the ranking. Because if you want to readjust, you got to make sure to decide which ones are worth what in your system, in your head. So 1 to 5, 1 to 10, whatever you have in your portfolio. And that's basically is going to save you a lot of money. So I hope this was helpful. Thank you so much for lasting this long. A huge shout out to the channel members, to the patrons. You guys are awesome. Thank you so much. I love you all. I'll see you tomorrow.